Broadcom, ticker AVGO, is a critical supplier of essential computer chips and complex software that powers the digital world for countless other businesses. These numbers aren't just abstract figures, they are anchors that help us begin to understand a complex story in simple terms. Broadcom is a company that lives at the intersection of hardware and software. In one sentence, it designs and sells a vast range of semiconductor and infrastructure software solutions. This means it makes the tiny, powerful components inside data centers, smartphones, and network switches. To understand Broadcom, you have to look at its two powerful engines: semiconductors, infrastructure software. The semiconductor division is the company's historical core, producing a dizzying array of chips that manage data. Make your Wi-Fi faster, your phone connect to 5G, a massive data center process information efficiently. These aren't the glamorous CPUs, they're the unseen plumbing of the digital world. Broadcom has a dominant position in many of these niche markets, making its products hard to replace without redesigning entire systems. That creates sticky customer relationships built on deep technical integration. The second engine, software, was built largely through acquisitions like CA Technologies. Symantec's enterprise business. This part sells mission-critical software to large enterprises, from mainframe computers to network security. Unlike the volatile chip market, software revenue is more predictable, long-term contracts and subscriptions. That balances hardware cyclicality. The software side is a financial stabilizer, providing income that helps fund research, pay down debt, and support the dividend. One of the most significant risks facing Broadcom is its substantial debt load. The company's growth by acquisition strategy has been funded in large part by borrowing vast sums of money. As of late 2025, while manageable, the debt on its balance sheet is a figure that cannot be ignored. In a stable economic environment with low interest rates, this debt is a tool for growth. However, in a scenario with rising interest rates or an economic slowdown, that debt can quickly become an albatross. High debt payments can siphon away cash that would otherwise be used for innovation dividends or weathering a market downturn. This financial leverage amplifies both gains and losses, making the company more vulnerable to macroeconomic shocks. A second ever-present risk is regulatory scrutiny. As one of the largest and most influential technology companies in the world, Broadcom's every major move is watched closely by governments in the United States, Europe, and Asia. Its acquisitions in particular face intense antitrust reviews. Regulators are increasingly concerned about market consolidation and the potential for a single company to wield too much power over essential technology supply chains. The risk is twofold. A future blockbuster acquisition could be blocked, limiting a key avenue for growth, or regulators could impose conditions on past or future deals that restrict the company's business practices and harm its profitability. On the other side of the ledger, there is tremendous reason for hope, primarily rooted in the company's indispensable role in the modern economy. One major tailwind is the ongoing digital transformation across every industry, from healthcare to manufacturing to finance. Organizations are racing to digitize their operations, and this process requires a massive build-out of network infrastructure. Broadcom's networking chips, custom processors, and storage solutions are the fundamental building blocks for this transformation. As long as this global trend continues, the underlying demand for Broadcom's core products should remain robust, providing a powerful updraft for revenue growth regardless of short-term economic fluctuations. Another reason for optimism is the company's disciplined and shareholder-friendly capital allocation policy. The management team has a clear and consistent track record of generating strong free cash flow and returning a significant portion of it to investors. The commitment to a growing dividend provides a powerful incentive for long-term investors to hold the stock through market cycles. This financial discipline also extends to its operational management, where the focus is relentlessly on profitability and efficiency. This combination of strong cash generation and a commitment to shareholder returns provides a measure of stability and a clear value proposition that stands out in the often speculative technology sector. On the other hand, Pure-play software companies, like Oracle or Microsoft, enjoy the stability of recurring revenue Oracle Microsoft, but miss out on the explosive growth that can come from a hardware breakthrough. Broadcom attempts to blend the best of both worlds, mixing the high-growth potential of chips with the steady cash flow of software. This makes it a different kind of company, less a nimble speedboat, more a massive, powerful tanker. For a new investor, the most important variable is time. Your investment horizon changes everything. If you are building a portfolio for retirement decades away, the cyclical swings of the semiconductor industry and the risks of acquisition debt may appear as temporary turbulence on a long and upward journey. You have time to allow the company's long-term strategy to play out. However, if you might need your capital in the next 2 or 3 years, the potential for a market downturn, a regulatory headache could lead to painful short-term losses. This is why it's critical to look at the simple foundational numbers. The dividend yield provides a return, while you wait. Profit growth signals underlying health. Debt levels indicate the degree of financial risk you are taking on. It is a timeless truth of investing that past performance is no guarantee of future results. Broadcom currently exhibits strong cash flow, a dominant market position, and a clear strategy.